Hi, this is Zach Happenstall, CEO and co-founder of Rise 48 Equity. At Rise 48, we've successfully purchased 38 different properties worth over $1.5 billion worth of real estate and gone full cycle and sold 11 different properties, drastically exceeding projections for our investors. If you're looking to invest with an experienced sponsor in either the Phoenix, Arizona, or Dallas, Texas markets, then we're the group for you. To learn more about investing with us, visit our website at rise48equity.com and set up a call with me. Thank you.
I don't bet on refining anytime soon in the next 5 years, but I'm looking at a deal and saying, okay, I'm going to lock in this cash flow investment for the next 5 years and maybe not make 15, 20% on my money, but at least I'll make 8, 9% cash flow. I'll take that.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
This is Jeremy Roll, and you're listening to the Passive Investing from Left Field podcast.
All right, today I'm excited to have Matt Faircloth back on the show with us. Matt is co-founder of the DeRosa Group, a real estate investment company committed to transforming lives through real estate. Matt and his wife, Liz, started investing in real estate back in 2004 with a $30,000 loan. And then Matt soon quit his job and together they founded DeRosa Group in 2005. Since that time, they've successfully completed projects involving dozens of fixes and flips, office buildings, single-family homes, and apartment buildings. He's a frequent guest on the Bigger Pockets podcast and regularly contributes to Bigger Pockets educational webinars and boot camps, as well as being the author of the book, Raising Private Capital, published by Bigger Pockets. And he will be joining us as a presenter at the Best Ever Conference on April 9th in Salt Lake City. Matt, welcome back to Passive Investing from Left Field podcast.
Chad, great to be back, man. Thanks for having me.
Absolutely. No, we appreciate you coming back on too. We usually start out with your journey. You were on episode 132 for us back in September.
Yeah.
Liz, your wife, was on episode 38. So we'd have to go through a full journey of the backstory, but maybe you could give a little update.
Done that journey.
Yeah, exactly.
Yeah,
People can pull those in if they want to hear more, but maybe a little detail in the background that I didn't cover already.
Yeah, no problem. I'll give it to you in like 20 seconds or less. My wife, my girlfriend at the time, now wife of 18 years, put Rich Dad Poor Dad in my hand in 2003, 4, somewhere in there. Bought a single family home, lived in it, rented it out to 2 buddies of mine while I was living there. So like a house hack, as they say. And that we never turned back from there and just got into residential real estate investing and built a business over time. Started the DeRosa Group when we had got married, which DeRosa is her mother's maiden name. Just like a good paisano shout out, right? You know, and here we are. We just slowly scaled into bigger and bigger deals and started raising capital back in 2011 from individuals and family members and stuff like that, and built it out from there. And now we're sitting on a couple thousand units of multifamily. We have a fund and new assets, which I'm sure we'll talk about too. So I'm blessed and grateful.
No, that's fantastic. And never a bad idea to pay homage to the mother-in-law. That's for
sure.
So
we'll shout out. Right.
Smart move.
Especially when they're Italian. You get your legs broken that way if you don't. So
exactly.
Yeah.
So we asked you to come back on the show because you were on in September. There's actually been a lot that's changed in the economic world and in passive investing, right, since that time.
Yeah.
So a lot of it was just, let's pull you back in, see what's changed. How are you approaching things differently? What's new in the world of investing since we last talked to you, kind of thing.
This is bottom. It's be like the end of the show. Everything has changed.
Yes,
Everything has changed. The end. Yeah.
I
mean, like it's been one of the most, like the last, like not even since September, like the last year and a half or so in real estate has been probably one of the most dynamic changes I've seen since 2008. And I was investing in 2008, and that's not the same thing. This is not the same thing that we're seeing now that we saw in 2008, nor do I think we'll see another one of those. But the field has changed quite a bit in the last year and a half, right? And so for example, Chad, DeRosa underwrote, meaning like evaluated 290 multifamily deals, I think it was. So forgive me if I'm misquoting exactly. My underwriter he can tell you exactly how many it was, but it was somewhere in there. on multifamily opportunities. We bid a fraction of those. We made it to best and final on a fraction of that, and we missed on all of them because just the numbers did not work. And there are still the sellers are still somewhat unreasonable, and there's still buyers out there that are willing to pay whatever the seller's asking just so they can get into the game or do a deal, so to speak. And so it's feels like the wild, wild west in some ways. And in some ways, I feel like the bias that some buyers and the sellers all think it's still 2018, and ourselves, the mortgage brokers and the real estate brokers deep down realize that things have changed quite a bit. So it's almost, you kind of wait for another shoe to drop, which I think is starting to hit the ground a little bit. So we're seeing real material changes happening in asking and in deals being offered around quietly that were bought recently, and it's very clear that they're underwater. So
yeah, interesting. Yeah. I'm guessing you probably even see that from your investor base as well. They're still expecting IRRs at a high amount that just aren't happening now. Cash flow happening just as quick as it ever did. Yeah, I would assume you're seeing that across the spectrum, probably, right?
Yes. So we're very pragmatic of an investment company. We're not a company that's gonna just go and blindly, pay out a pref no matter what, like rain, sleet, or snow, your pref will be in the mail. That's not us. I mean, we do this wacky thing called paying out of cash flow. And so if the property doesn't cash flow, or if there's not direct income coming from the assets, we're not going to pay out anything or a distribution. So for a while there, we didn't. While things changed and while rates came up, and while there was a major shift in income from properties and in rates and everything like that, we took a major pause on distributions. And so it's funny because we got, some investors were calling us, wait, you guys aren't paying distributions, and like, we got you. It's okay. It's all right. But the reason we're not is because of, financial performance, and we're going to pay out property performance and everything like that. Now, those properties that we halted on are all distributing again, right? But we got compared to other operators back in those days being like, well, XYZ company is paying me my exact pref to the letter. And it's, by the way, guys, if you're an investor and an syndicator sending you exactly the pref, come on. Let's question that, because it sounds like you're just getting money so that you don't ask questions, right? For us, we're willing to engage in the questions, but we pay what the property is performing at, right? And it's interesting that we've been able to turn the spigot back on because we took a break and we're financially conservative, and that kind of got us through a little bit of the last year. Those companies that were paying distributions like clockwork, as I hear from our investors, are now starting to say, well, we might want to be holding off on distributions for a little bit or whatever it is. And it's like, had you just been transparent a while ago, then maybe you wouldn't, maybe the story wouldn't have had to change here. It's just different philosophies. It right? Is, yeah. We decided to subscribe to transparency. So.
I feel like there was an education needed on both sides. The GPs needed to figure out that it was okay to do that, but the investors needed to really pay attention to, no, the GP is protecting my capital, my investment, by pausing at this point in time, because they don't have to come back and do capital calls later, hopefully, if they manage this better. So
right. I'd rather hold off on a couple months of pref than to have to do a capital call. $30,000. That's an easy choice, Right.
So we had to help kind of get that message conveyed in the community a lot, because there was a lot of uproar in the forums of, oh, this person stopped now and this person stopped now. And it was like, that's okay. That's
they're doing the right thing. That's the thing. It's like you got you're buying a real estate equity piece is not the same as buying like a bond that's they use the G word, guarantee, that they're going to send you a distribution monthly, whatever it is. Like, there's no guarantee that a real estate syndication is going to be paying you anything. Yeah. And you can't count on that pref in being like a direct coupon. You want a direct coupon, there's dividend yielding stock out there. There's dividend yielding like municipal bonds you can buy that are more likely that can guarantee a monthly payment, which the syndicator should not even be using anywhere near those kind of language, nor should an LP be expecting those things.
Exactly.
So
you're exactly right. This is how the last year and a half has felt. How have your strategies changed then as you're approaching? You didn't land any deals last year or for the
Went
last
from the harm of
290
trying, man.
chances.
You
Yeah.
know?
But and that's maybe part of the strategy of like, make sure we stick to our due diligence.
We're
here.
very disciplined. We have
yeah.
we have underwriters that are more. They're lucky I'm not underwriting because I'm a little more aggressive, like, and everything like that. But I've learned to have people work for our company that are not of the same personality as me, and that's like executive leadership 101, right? And so there are people that are way more conservative, way more pessimistic than I am, that are evaluating deals. I've never had a bad day. I'm an optimist, right? So you don't want optimists underwriting deals. You want people that are willing to think about the absolute worst case thing ever that could happen. and that are architecting the deal structure to hedge against that, right? So we stuck to our guns and didn't do any deals. But we also, good news, we started looking at new asset classes. We're looking at branded hotels now, right? And every time I bring that up, people are like, oh, because you're going to convert it to a multifamily. No. And then that's a noble cause, because there maybe is too many outdated hotels that need a major investment. And it begs the question, if you're going to go invest in 30, 40K a door into this site, you might as well make it something different. And you could make it into an apartment building. There are people out there doing that. That's not what we're doing, right? We are looking to buy major brands like you've heard of, like, Marriott, Hilton, Holiday Inn brands, right? And keep them as such, because those properties do this wacky thing that multifamily has not done in a long time. And that thing is called cash flowing the first day you buy it. They make reasonable cash flows. These are fairly good cash cows. So we really love the branded hotel space. It's not like multifamily though. So it's not something that you're going to get in and invest X amount of dollars to make $25 a door in rent, and then the property doubles in value in NOI. So it's not a low cap rate investment that every dollar that gets squeezed out of it in NOI means tremendous increase in property value. These hotels typically trade in the way higher cap rate range. And because of that, they generate really good money when you buy them, but they are not huge value add plays like multifamily or other, self-storage or those kind of spaces are.
Yeah, no, that makes sense.
Yeah.
I assume you're staying in the asset classes you're in, the tried and trues, keep looking at multifamily and that kind of thing.
We'll bid it. I'll underwrite another 200 and some odd deals this year, Chad. We'll do that Winston Churchill thing. Like, we'll go from losing a deal to losing a deal in the bidding process, and never lose any enthusiasm. Right. So,
that's right. Good for you.
Yeah.
The short memory kind of thing. Is that?
Yeah. Well, yeah, we're very committed to market. We're a market committed company. And I think that what's going to breed success this year in 2024 for operators is those that are market disciplined, not operators that are looking to invest in 20, 30 markets across the United States and just bidding on whatever LoopNet shows them the best ROI is. We're only in like 2 markets right now, the Piedmont Triad in North Carolina and Lexington, Kentucky. That's it.
Gotcha.
So
with that,
we'll buy more there, but that's it.
Yeah, no, that makes sense. With that discipline to stay that focused in your multifamily markets and so forth, what was the logic that led you to the hotel, at least starting to look down that path, just as an enhancement too, or you see benefits there that, are intriguing to you? What took you down that journey to get into that space?
Well, okay. There are things that drive a multifamily market that speaks to multifamily, right? There are other things that drive markets that are conducive to hotel investments, right? And so we are shopping a handful of markets, same DeRosa philosophy, not 30 markets, not 15, probably 2, that we're shopping in hotels. Not ready for prime time yet, Chad. I have to come back on when I got it. When we're under contract on something, I'll come back on and you and I can talk more shop on what markets we really like on hotels. But I really we practice what we preach with regards to market shopping. But there's a handful of markets we really like for hotel growth, and those, like, hotel growth is not necessarily the same thing that yields multifamily growth. It's all about jobs and job diversity. That's what we look for. right? And jobs that feed the demographic that we're shopping. We invest in median income. That is our market. So C class, B class housing. That's what we go for. Not A class, not bougie, not just, that's it. Workforce luxury is what we call it. So that means that you got to have jobs that feed the middle of the spectrum, right? That feed middle America. That's if you got those kind of jobs, that's what I go after. That's multifamily, right? Not so for hotels. For hotels, you want other things. You want business travelers, like a people that are in and out. So maybe a little more higher end jobs, you also want to have some sort of a tourism element, and the one factor as I got into hotels, Chad, the thing that you want to look for that I didn't think was a thing, but we have a high end hotel underwriter that works for our company now. And what he's taught us is that what you want to go after is markets that have a lot of collegiate and high school travel, right? Yeah. Think about this, right? It blew my mind, right? But think about this. You got a bus full of high school kids that have a tennis tournament or a soccer tournament, whatever. Where do they got to stay? They're certainly not going to rent an Airbnb. They're pulling that big old coach bus full of screaming teenagers or whatever. That's going to go stop at a Holiday Inn Express or whatever before they play their tournament. So and the same thing for college kids or whatever. So collegiate and high school tournament travel. And those tournaments tend to happen in specific cities because those specific cities have made real investments in facilities that house these types of events, right? But they don't happen everywhere. They happen in specific places. So that's a big thing that's a factor. Believe it or not. I mean, it's wacky what goes into the evaluation on these markets.
And it's such a spin from the norm.
Yeah.
That's interesting. As a father of a travel soccer player for several
years.
You know
what I'm talking about?
Yeah, I get it.
You've written a lot of checks to Holiday Inn Express.
You want to wear those kids out a little bit while they're there.
Right. You want to request that the coach, like, hey, I have Marriott points. Can you guys make sure that you do a Marriott so I can get the points for the hotel stop for my kids' soccer tournament? Or can my kids stay across town at the Hilton property? Because I'm almost to next status,
Exactly.
Right.
Oh, but great. But to pull it back to the changes that are going on, I won't make you talk hotel the whole time we're on here.
Yeah, it's all good.
To pull you back into that, one of the things I wanted to ask you is things have changed. What kind of metrics have changed for you to put a bigger focus on, would you say? And as a caveat to that, maybe what LPs should be paying attention to more as they're reviewing deals that are finally brought to them because the deals have gotten kind of tighter. Are there changes in metrics that you've really put more emphasis on? And should LPs put more emphasis on something different while they're there?
Yeah. I mean, whatever I think that the economy is going to be more unpredictable and soft the next couple of years, right? If that's the case, then you don't want to invest in big upside deals where it's like, we're going to buy it for X, we're going to sell it for 2X 3 years from now, and we're all going to make lots of money. Let's go, right? That conversation was like a heck yes conversation in 2015, 16, 17, 18, 19, right? That's not the conversation anymore. If I were an LP, I'd be very cautious of deals where a lot of my IRR profit is made off of appreciation, right? Because the tea leaves that I'm reading, the people that I respect, sometimes the same people that you guys have on the show and stuff like that, like mutual friends of ours, would predict that rates are going to stay where they're at. Cap rates are probably going to continue to expand a little bit. And if you're investing in a deal that is relying on a cap rate staying low-ish for the deal to make money, meaning like we're going to get in here and we're going to bump rents $50 a door. We're going to do value add, $100 a door, whatever it is. And that's how we're going to achieve big bumps. And then we're going to refinance and we're going to sell. That conversation has worked really, really well the last 8 years, but that's not the conversation anymore. The deals have to cash flow. And so if I were an LP, and I am an LP. I mean, my wife and I have a good, we have LP money at work in non-DeRosa deals and other people and other operators' projects. And we look for deals that cash flow the day that we buy them. If it doesn't cash flow the first day, I'm not going to do it. I'm not doing the deal. As a buyer, as an operator, as a GP, and also as an LP. Because I think cash flow, Chad, is what got me through 2008, 9, 10, when everybody was still playing, upside and bumps and stuff like that. We stuck to cash flow. And that got us through the downturn of the market. And I think that's what's going to separate success from not the next couple of years too.
Well, it seems like loan structures got so complicated, or got, maybe I shouldn't say complicated. Maybe I should say we paid attention to it more as LPs than we did 5 years ago, because everybody was successful 5 years ago. Everything was going up. Appreciation was king and was bailing people out left and right. That was a big pivot that I saw when we got into the last couple of years of, oh my gosh, we really should run. When some of the smaller banks started having trouble, we ran and saw who were these deals were financed with. And then we started looking at, is there cap rate, variable lines? Are there cap rate tops that we can watch out for? Those kind of things. How's that strategy changed for you from a loan structure as you've been doing this through the past few years?
Well, I mean, everybody and their mom was doing bridge debt up until recently because it got so expensive or whatever. We have bridge. We still, we've unloaded most of them, not sold, but we've refinanced out of. But we've got a few bridge debt deals left. But luckily enough, we went in conservative on them or whatever. We went in conservative enough. We've got plenty of cash reserves, and the rate caps are not a major issue, and yada yada yada. Right. So lucky us. But we would not be getting involved in a floating rate debt deal moving forward. Right? I think that the way that you protect cash flow is through fixing interest rates. Being conservative on expenses, somewhat conservative on revenue, on income. Because I don't think rents are going to go 5, 10, 15% increases like they have in the past. That's not going to work either. So if a deal cash flows day one and your debt's fixed, then I think that you're fairly good to go. That's going to probably carry you the next couple of years. Even if expenses creep up a little bit, even if revenue doesn't 5 to 10% increase, if your deal's making money today, cash flow today will get you through the storm, even if it's like 5, 6, 7% cash on cash, not 10, 11, 12, right? So fixed rate debt is the answer. And I mean, it's nice if the debt performs once it's amortizing. Most of the agency debt deals you see people do are interest only, and you want to do the math to say like, well, how far upside down would this deal be if the debt started amortizing? And if I'm an LP, I'm looking at that. So that's something to look at as well.
It seems like some of the logic with the rates as high as they went was, do variable because the rates are bound to come down. Mm-hmm. I guess the catch is if you did fixed rate and it drops far enough that it makes mathematical sense, you could always refi. You've hopefully done some fix to the property, so you got more value there, and you get a lower rate. You got a refi as a strategy still, I would think. That could still play in and still get you those cheaper interest rates. If it makes sense.
Not to get into into weeds, but it's an interesting conversation, right? I could go in and lock like floating rate debt at like 8.5%, crossing my fingers, like I'm going to leave a spoon under my pillow and cross my fingers and cross my toes that rates go down at some point in the next year. And then I can refi at like 5.5, 4. Those deals are out there, the people that are thinking that's what's going to happen, but I can't control that. I can't control what future rates are going to be. So I'm okay being in a deal with rates that are locked at 5.5, 6 for the next 5 years, as long as the deal cash flows, right? If it cash flows now, if rates go down, then I'll either refi or sell in 5 years or whatnot. But like you're likely not going to refi out of that deal because there's a lot of like CMBS loans have hooks in them on refinancing. Agency debt has hooks in you on refinancing. Prepayment penalties, defeasements, yield maintenance, all that fun stuff. So you're likely not going to get out of that expensive debt for the foreseeable future. But what you will happen is rates eventually settle back down. They eventually come down a little bit, probably not down to 2.5%, 3%. We might not see those days anytime soon. But if rates have probably hit their top. Like I'd be willing to bet on that. Their rates are towards the high side of where they're going to go. Then if they don't move at all, and my deal's at 6% interest for 5 years, then, and if I'm cash flowing, then I should be able to cash flow again at 6% interest on a refi. It's only going to help me if rates go down. So I'm willing to bet on that, and I don't bet on refining anytime soon in the next 5 years. But I'm looking at a deal and saying, okay, I'm going to lock in this cash flow investment for the next 5 years, and maybe not make 15-20% on my money, but at least I'll make 8-9% cash flow. I'll take that. I think that's going to be the real numbers that we're going to have to take. But the performance is based on annual, like I'm getting that now, time value of money, versus crossing my fingers and hoping the deal pays me a big check 3 to 5 years from now.
Exactly.
Rust Belt Capital is an elite Ohio-based private equity firm with a specialization in long-term, high cash flow multifamily investments. If you're looking for long-term recurring income, you should check out Rust Belt Capital. From their approach to managing risk to the locations they invest, the product quality they provide, this firm is serious about what they do, which is why the owners of Rust Belt Capital invest their money in every deal they take on. Review their case studies by visiting rustbeltcapital.com. That's rustbeltcapital.com. Once again, rustbeltcapital.com, or email investor@rustbeltcapital.com.
Hi folks, Ben Lapidus here, your host of the Best Ever Conference, dropping some exciting news. If you are a passive investor looking for a like-minded network and dozens of high-quality operators to personally meet, then you're going to want to hear more about this incredible new mashup. Left Field Investors is joining this year's Best Ever Conference to create the most exclusive combination of networking and conference content available to the passive investor community anywhere. If you're already an infielder, then you get access to both events for less than the cost of one. And if you're not an infielder, then what are you doing? Sign up already! In addition to a year's membership, you get access to the LFI Day at Best Ever Conference on April 9th in Salt Lake City, followed by 3 phenomenal days of learning and connecting at the 8th annual Best Ever Conference, where hundreds of operators showcase their best deals and hundreds of passive investors come to learn, invest, and party with each other. We have many masterminds, game shows, intellectual debates, pitch competitions, speed networking, partner hunting, almost 100 speakers, party after party after party, and the tail end of snow season in beautiful Salt Lake Valley. Be sure to claim an exclusively discounted price of $800 and join us in Salt Lake, April 9th through 12th for the event of the year. Check us out at besteverconference.com for more info.
Is that kind of a change in your contingency approach on how you're analyzing deals this day that maybe you didn't do 5 years ago?
Oh, yeah.
Is this part of that? What the economy's done has affected how you analyze deals and why you went through 290 and didn't do any?
Yeah, it is.
It's just
unfortunately, a lot of multifamily deals don't cash flow day one. Most don't.
Yeah.
Most don't, because cap rates are too low, right?
Yeah.
That if I got to borrow money from Fannie Mae at 6.5%, and the seller still wants a 5.5% cap rate on their sales price, that deal's not going to cash flow. It's just not, But cap rates have slowly crept up a little bit, over time, and so we're almost there. There is some distress coming on for people that likely overpaid. So I'll give you a few to transition, Chad. I'll give you a few tactics that we are looking at. We're still bidding lots of multifamily, and the gap between bid and ask, between buy and sell, is slowly closing. It's not collapsing, but it's we're getting there, right? And we've also seen a little bit more distress, not like blood in the streets distress, which we're going to see, but let's just say folks are a little more motivated than we were 6 months ago. Right? That's starting to show up. So I think there'll be realism in 2024. But the other thing that DeRosa is doing is, again, I can't say it enough. This is like the buzzword. People should get $1 every time I say the word on the show, is cash flow, right? We created a cash flow vehicle, a debt fund, right? That we are, bringing in money from LPs, and a lot of my personal money is in it as well. And we're investing in generating one of my favorite investment vehicles. It's not a tax hedge. It's just a cash flow hedge, which is hard money loans. And so we have a fund that has a bunch of hard money loans out on the market right now. And we also pay upside to our investors and whatnot. So it's a win-win. So it's not like a fixed rate of return like a traditional debt fund is. It's whatever I can put the money on the street for. If 12, 14, 15%, investors get a piece of that. So the more I can sell the money for, the more money they make. So it's a win-win. And there's no fees or whatever. So we developed that vehicle, and it's a good hedge. It's a good piece for us to, as we wait for multifamily to come back around. We generated that, and it's going really well, but it's cash flowing. There's no upside. It's just whatever the fund makes in a month that pays it out. That's it.
Well, and it's that cash drag almost of we don't want to lump it into a multifamily fix up that's going to take 5-7 years to see back because we don't think it really works. Here's a good place to at least put money in the meantime, make something on it, get it back at returns quicker.
I look for liquidity too as an investor because I think that LPs should be looking for liquidity right now. The multifamily syndications are phenomenal, but you lock your money up for 5 years, sometimes longer, right? And so liquidity is a good solution to that. Most funds like ours are liquid. And there's a bajillion other funds out there that have some lockup period, but then liquidity soon after that. So I would seek out, if you're not going to get the tax benefits from cost seg and that kind of jazz, if you don't need that per se, I would seek out a fund that's got some liquidity component that you could get in on, and even better if you can compound your returns, which yet another thing is syndication and multifamily can't do. You can't take your cash flow and like buy more shares of the property because the property's only got like 100 units. It's not like we're adding units or like, oh, we're gonna make it 101 units and 102 and 103. There's no more cap revenue stream for you to buy back into. But an open fund, many options out there for these kinds of things, have the ability for investors to compound, and they're liquid. So that's what I would be looking for if I were an LP right now. Well, I kind of wait for the economy to settle down and chill out a little bit. Yeah, that's what I'd be looking for.
No, that's good. One last thing I wanted to ask you, kind of related to all this, and you've talked about cash flow is almost king again, if it never went away really. But how, in this economy with everything that's changed, how do you approach the exit strategies with an asset that's cash flowing differently now, maybe than you did a few years ago, with cap rates being what they are and everything else too? Are you more tending to hold for a longer period of time and not get out because they're cash flowing, or has that approach changed any in your
I think the concept of buy and hold real estate is going to become more back in fashion, right? It became passe. It became, well, the cool kids are, buying a property and selling it again in 6 months or in 18 months or whatever it is, and generating 3x equity multiples and right? Well, it doesn't work anymore, right? So I think that what we're going to get back to, which is what we did. I mean, I got started as a smaller landlord buying duplexes, triplexes, that kind of stuff. And I mean, when you buy a smaller real estate investment, even like I had a 10 unit at one point, assets like that, you buy them, you hold them, you cash flow them. And then when it makes sense, at some point when the market is yielding a good return, or when you want to move on, then you sell it, right? But having a sales date in the future on the time horizon of 3-5 years, whatever it is, that's all crystal ball, predictions, right? Who knows if the market's going to be there? And I think that if you're making money, even if it's like mid to high single digits, maybe that's good enough for now. And then when things continue to expand and push, the market will tell you when it is time to sell, and maybe that's what we get back to, is just cash flowing until, okay, looks like we're approaching a favorable exit now. Let's take it. And that could be 2 years from now, could be 7 years from now.
Yeah. Well, and as an LP, those are the words I like to hear from my general partners that are bringing offers to me of, don't feel like we're on a specific timeline and you got to make it happen. Let's have multiple exit strategies that can maximize all of our growth in this deal. Don't be pigeonholed by what you've set up when you did all your performance to begin with. So that's great. Matt, this is all great. Last question I'll throw at you. We always like to ask, what's a really good podcast that you listen to that you'd like to share? So we can throw that in the show notes as well.
Well, of course, Chad, the Left Field Investor Show.
Oh, yeah. Thank you so much. Thank you so much.
No,
that wasn't understood. We understand.
I will throw out a good friends show. This is not one to listen to when you got the kids in the car, if you know what I'm saying. But this is one that you and I have talked about recently. We've shared some laughs about it, and that is the Drunk Real Estate Show. And I've gone on it recently as a guest. It is a real talk, gloves off, sometimes, rated PG-13 show, with the language and everything like that.
Yeah.
The hosts, and I was lucky enough to be a guest host last week. The hosts show up with a cocktail in their hand and everything like that. And so it's fun.
You held your own, did a very nice job on that too, by the way. Yes.
Thank you. I hope I impressed them enough to come back on.
There you go.
That was a lot of fun.
There you go. No, that's great. That's good. And then just hit us up where listeners can reach out to you. Where's the contact information?
As always, guys, DeRosaGroup.com, DEROSA, DeRosaGroup.com is where you can hear more about us, what we offer, what we're up to these days, learn more about our company at that website.
Perfect. Very good. Well, Matt, thank you for coming on again. We'll have to get Liz on now to even this out a little bit, but we appreciate you.
I'm going to go talk trash to her that I was on your show and that I've been on it. I've been
right.
on it twice. She's only been on it once. So
she got on before you, though, so she may have that to hold over your head too.
She did, as always, as a good man that's got a great woman behind. I'm only a good man. She's a great woman, and she's pushing us along. So I'm very, very lucky to have her in my corner.
Good answer.
Yeah.
Well, Matt, good to talk to you.
Story, and I'm sticking to it, Chad.
All right. We'll talk to you soon.
Cool. Thanks for having me.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Su, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor. 20 lessons learned from 14 years of investing in private syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book. Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndications to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return, Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co.
Really enjoyed that conversation with Matt Faircloth. Matt and Liz both are great to talk to any chance we get. Hopefully you found value in that as well. I thought it was very interesting to hear how he called out things like right now we're in maybe the most dynamic market than we've been in since 2008. It definitely feels like that's been the case. And who knows where that ending is. Found it interesting that he mentioned how many deals he'd looked at, 290 deals, and didn't find any that he liked. So they passed on all of them. I like hearing that from my general partners because I like seeing their conservative nature to make sure that they're investing my money in an asset that's going to work, not force it to play in a market that's tough. Rather take the time right now and wait for the next good deal to come. It will be coming. We will get them, but don't be in a rush to do it. I like how he focuses on cash flow as well and underwriting in that very conservative nature of focusing on, what's going to work in a market that even gets worse than we are in today. So I love hearing that about his approach to investing. I liked how he talked about some of the metrics and how they're becoming more unpredictable, putting, caution on investing in an asset class that needs a big capital expenditure, a lot of fixing up in the early time being, because it just may not work out in the numbers that we have right now. And also not expecting a lot of appreciation. We've been on a huge appreciation train for the last several years, and that's probably slowed down. So, don't expect to see big numbers, or if you do, question them in the offerings that we get. And I did find it interesting how he talked about he feels like the gap between the buyer and the seller is shrinking. They are getting closer together, which just means that the realism, as he pointed out, 2024 is going to be the year of realism, of getting everybody back on the same page between buying, selling, and the LP investors, if you will. And lastly, I like how he talked about his fund. I think it's an interesting model to look at. If deals aren't as prevalent as they used to be, it's nice to have some place to put cash that will still earn some money over the next several months until you're ready to jump back into a deal maybe. But look for liquid and cash flowing assets if you do that kind of thing, and focus on how much you can compound during that time. And lastly, I like this quote of buy and hold seems to be coming back in fashion. That's going to be interesting to watch and see how that sticks. But hopefully you all enjoyed the show as well and took some good nuggets from Matt's feedback also. Thank you for listening in.
Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.